Well, one of the signs of spring is that first quarter earnings season starts to rear its head. We're making this video in the first week of April. By this time next week, we're going to start to see the beginnings of earnings season. It's interesting to see which companies are the bellwethers. It always used to be Motorola and Alcoa. Now it's basically J.P. Morgan and Wells Fargo. But the names have changed, but the idea remains the same. The thing to me to watch most for is, can these companies deliver vis-a-vis expectations, and are expectations reasonable? It's difficult actually having banks lead off the earnings season because there's so many moving parts in a bank. Banks effectively have the world's largest couch cushions, or when numbers don't necessarily meet, they can always blame it on the trading desks, which as a trader has always been infuriating. So I wouldn't read too much necessarily into what you see in J.P. Morgan and Wells Fargo, unless what they're saying about the broader economy is difficult. And when you do start to hear from the banks, you're going to get in rapid succession. You're going to get J.P. Morgan, Wells Fargo, Citi, PNC, Bank America. These companies, while they have very idiosyncratic earning streams and balance sheets, they have great insight into corporate America because that's who their customers are, that's who they're lending money to. And so I would look for any commentary out of there. I guess the other question you have is, we're coming in with a bit of euphoria. And remember, the problem with earnings, I think it was Keynes who said this, that it's really not more about picking stocks, but especially appropriate earnings time. It's not necessarily the idea of figuring out who's going to win the beauty contest. It's figuring out who everybody else thinks is going to win the beauty contest, which is to say, like, how are expectations being measured right now? And this is a very tricky one because from a top-down approach, S&P earnings are generally expected to be flat to negative. Yet stock performance certainly doesn't act as though we're in a tepid earnings situation. So you really, I think, run some risk here of some major disappointment or some major outperformance. One of the things that was fascinating around first quarter earnings season was you actually saw companies go up when they beat, which is actually not all that normal. Usually earnings is more of a one-tailed event. Companies disappoint and they get throttled. I would say the underpinnings of the market are very different now than they were 3 months ago. At that point, we were coming off of a very oversold condition, and I think people wanted the assurance that it was safe to go back in the water when companies reported good numbers or good guidance. I fear now that you've hit almost a psychological reversal in that regard, that we're probably nearer to overbought than oversold. We're certainly not oversold. And you have to wonder whether also the dearth of earnings pre-announcements that we've gotten makes people a bit more sanguine that the companies are going to release good numbers. I think to Walgreens, which came out this week with a pre-announcement, and the market was certainly not happy to see that. So the thing that I would be looking for would be, do you feel, and this is as much qualitative as quantitative, because you have no visibility into earnings. Nobody does, in truth, unless because the companies guide, but they don't really tell you. So do you feel that the market is appropriately evaluating the company's prospects? And I would be, from a broader market sense, starting to hear what the guidance is. Are companies starting to guide with an eye toward economic growth the next few quarters, or companies start to guide and say that the next couple of quarters is rocky? If it's the latter, that can be pretty challenging for the market, and we may end up seeing a sell in May go away if the latter scenario is true.